Hey, I'm Ashley Tullis, and professionally, I'm a realtor with Realty One Group, Mountain Desert. But today, I'm just another citizen of Flagstaff, and we're talking common sense. So, we have Kyle Kent here with us today from VIP Lending here in town to share his common sense with us. So, hey, Kyle, what is your common sense you want to share with us today?
Hey, Ashley, thanks for having me on today. Um, Common sense. Okay, so kind of a loaded question. When it comes to the lending world, common sense isn't so common. And the reason why I say that is because there's a lot of myths, right? Which I think we should just kind of get out of the way and squash them right here and now for anybody that's watching these or watching or listening to this podcast. And I think the number one myth that most people get stuck on is that you have to have 20% down to buy a house. 20% down is preferred if you have the money to do that. And just throw that out there too. There's ways that you can get that money, whether you have it or not, right? You can get a gift from a family member or a close friend, depending on the program, which I'm seeing a lot of parents helping out their kids, with a gift, if needed. But you don't have to have 20% down. Actually, you only need 3% down if you're a first time home buyer and you're buying a single family home, okay? Or 3.5% down if we go with an FHA loan. So that's probably the biggest myth is, the whole 20% down thing is really preventing people from buying homes because they feel like that's just not obtainable for them. And with home prices going up, quite significantly with COVID, it is a little bit more out of reach for a lot of people, right? To save up that money to put down on a house. So you don't need 20%. And if you're putting less than 20% down on a conventional loan, you're going to have mortgage insurance, which also oftentimes gets a bad rap. But mortgage insurance isn't anything to be afraid of. It's there to help you become a homeowner without having as much capital upfront, right? And you got to remember too, is like when you're making a real estate, when you're buying a house, right? It's an investment. And it's one of the only investments where you can make a small investment that's going to compound on a greater level, right? So, for example, let's say you're buying a $400,000 house. You're going to put 3% down. That's $12,000. That house appreciates at 3% year over year, okay, at the $400,000 level, right? So you're appreciating on a $400,000 asset that you only have $12,000 into, right? So the return on your money is tenfold, depending on how much money you're putting down, right? So some people's strategy is really to put the minimum amount down if they're going to sell the house in the next few years because they're not over leveraged into it, right? So that's something to also take into consideration when you're buying houses. Like it's an investment, right? And on that same note is a lot of times for a down payment, like you can use things such as your 401k. Okay. So if you've got a 401k, it's considered a financial hardship when you buy a house. So if you're looking at your 401k policy, it's going to have verbiage in there that you can use it for financial hardship. Buying a house falls underneath that clause. Okay. So a lot of people will use their 401ks to purchase a house. Now, when you do that, it's important to keep in mind that all you're doing is you're trading one investment for another investment, right? Your 401k is your retirement account that you've been saving up, for however long through your employer, and your employer's matching, hopefully, right? Like, that's kind of the perk of a 401k. Hopefully your employer is matching, or if not, you're compounding that based on the market. You take money out of that 401k and you're putting into a house. Now that house is your new investment and is going to appreciate over time, right?
I didn't even know that you could take the money out of your 401k because I've got my 401ks just kind of floating out there from when I was a teacher. They would automatically give you a retirement account. So it's
Yeah.
kind of just floating out there. I don't even know how much is there, but that is actually good news because, my husband and I are hoping to get approved, maybe not purchase anything in town this year, but at least get approved and see what that looks like.
Yeah.
So that's good to know that you can
Yeah,
use
for
that
sure.
401k money.
Yep. So since you were a teacher, it's important to differentiate between Arizona State retirement and a
Oh,
401k. So if you
okay.
have Arizona State retirement, you can't use that money.
Gotcha.
If I'm not mistaken, you can't access that money until you're 50. Is it 59? Retirement age?
Gotcha. Yeah, see, I don't even know about those accounts, but
Yeah, but I mean, if you have an actual 401k or an IRA, something separate than your Arizona state retirement, um, then absolutely you can access that money to purchase a house. That Arizona state
okay.
retirement is kind of an outlier. It's a little bit different, right? Because it's funded by the state. Um,
Right.
so it's a little different than like employer contributions type deal. That's kind of tax dollars going to work, and they want it to stay in there compounding. So when you retire, you have a much more of a pension, right? Um,
Okay.
so yeah, absolutely. There's ways to come up with that money. So that leads us into another myth, and that is that down payment assistance programs are only for first time home buyers. That's false. You don't have to be a first time home buyer to use a down payment assistance program. It's also important to note that you're considered a first time home buyer if you haven't owned real estate in the last 3 years. So you could have owned real estate in the past, but now you relocated, you rented for a while, you've been in that place for 3 years, you haven't owned property for 3 years. You're now considered a first time home buyer again. All right. And the biggest perk as being a first time home buyer on a conventional loan, like I said, is you only have to put 3% down. Another myth about first time home buyers is a lot of people think that you can only use an FHA loan if you're a first time home buyer. Not true. You don't have to be a first time home buyer to utilize an FHA loan, which the minimum down payment on that is 3.5%. And that stays true across the board of pretty much whatever you're buying, versus conventional loans. That first time home buyer perk really only applies to like these single family homes or condos, right? If you're trying to buy a multiplex home, or you're trying to buy a manufactured home, down payment's going to change. Not going to be 3% anymore. Okay. Difference between a conventional loan and an FHA loan. Main difference is on a conventional loan, you will get rid of your mortgage insurance once you hit 78% loan to value on your loan, or you come in with 20% down. Okay. You won't have mortgage insurance. Anything less, you'll have mortgage insurance, but on a conventional loan, you get a break for every 5% down you put. So if you put 5% down, you're going to be in that upper range of mortgage insurance, which if you have good credit, still not going to be super terrible. All right. Nothing to be scared of. Like I said, it's there to help you buy a house. And then if you put 10% down, you get a break. 15% down, you get another break. 20% down, it goes away. FHA loans, really good for people that don't have a lot of money down or they don't have excellent credit. Okay. Really the teeter zone for an FHA versus conventional is 740.
Okay.
If you're putting minimum down. If you got a 740 FICO and you're putting 15% down, conventional usually always makes sense. Okay. But if you're putting 3% down and your FICO score is 740, probably want to go FHA. Go ahead and just put that additional 0.5% down. You're going to get a better rate. Mortgage insurance is probably going to be less. Okay. Anything less than a 740, probably looking at FHA, depending again, like on money down. That makes a big difference of whether you go FHA or conventional. If you have a 640 FICO and you're putting 20% down, you're probably still going to be looking at a conventional loan, right? Just not to have any mortgage insurance. But again, talk to your lender, give me a call. We'll run those scenarios for you. It is our job to find the best loan for you, right? We don't get paid. That's another myth. We don't get paid based on interest rate, or product or anything like that. So there's no incentive for us to put anybody in, a high price loan, right? Or a loan that's not good for them. It's our job to find the best loan for you, which is always going to be usually the lowest payment, right? Best interest rate, lowest MI kind of a deal, or tailored to the person's needs.
Now, here in Flagstaff, or even the surrounding areas like Williams, I know that there's the USDA loans that are 0% down. Are those easy to get? Are those a challenge? Tell us about those.
They can be a challenge, but they're definitely not impossible, and they're worth exploring. But you have to keep into consideration is, yes, you have to be buying in what's considered a rural area. So if you're buying in Flagstaff city limits, Phoenix city limits, USDA loan, there's no options, right? There's just, they're based on more rural communities. Zero down is great. You're still going to have upfront mortgage insurance on it. To qualify it's a little bit more stringent when it comes to the debt to income ratios, right? So FHA, you can go up to 56% on the back end. Okay. Conventional loan, you can only go to 50%. USDA loan, I think, is capped at 41%. So there's a big difference there. So like if you're going to be over that 41% limit, a USDA loan, if it's rural, we're probably going to be looking at, either a first-time home buyer conventional loan or an FHA loan instead. So it just depends. In Flagstaff, they are a little bit more difficult, or surrounding areas, unless you're looking at like Winslow. Winslow would be a good USDA area because they're lower priced homes. But even in Williams, just the price of homes, like you have to have a pretty substantial income in order to stay below that 41% threshold. And now when I said debt to income ratio, there's two ratios. Okay. There's the front end, which is just your housing expense. So that's your income divided by, whatever the mortgage payment's going to be. Okay. And then there's the back end, which is that percentage I'm talking about, that 41, 50, 56%. And that includes all debts that are on your mortgage, that's on your credit report, and any other, disclosable debts like a private note or something like that, right? We're going to add up all of those monthly obligations and then add in the new mortgage payment, and then it's going to be divided by your income, and that ratio can't be greater than 50% on a conventional loan, or 56 on an FHA loan, 41 on a USDA loan. And so that's what I'm saying. Like, once you start adding in people, like they have a car payment, they may have student loans, they have a couple credit card payments, and then try to hit that 41% mark, a little bit more difficult up here in Northern Arizona, right?
Yeah.
Just because home prices are high. But yeah, USDA loans, they're awesome. They're great loans. You don't have to have any money down. The guidelines just differ a little bit between, FHA, conventional, so on and so forth. The VA, of course, zero down. VA loan is probably the best loan product in the world. Okay. They're amazing products. And again, DTI ratios on those, there is none. It starts falling into what's called residual income. But I mean, you can qualify up in the 60 percentile range. It just kind of depends on what your residual income is. But that's kind of like lending 303.
Right.
Not lending 101.
Not
So
101.
I don't want to get too far into the weeds, but and like I told you, I could sit here and talk to you for hours upon hours about this stuff. And I love it. I'm very passionate about it. But yeah, those are definitely the big myths. So
Okay, there's lots of ins and outs that people don't know about lending. I mean, people oftentimes won't even call a lender, to get started because they have all these preconceived notions in their head. They're like, oh, well, there's no sense in calling right now because I haven't even looked at any homes, right? Which is not the way you want to go. You want to go the other way.
yeah,
So,
for sure. Yeah, I'm glad you brought that up. So realistically, the way that it should go for a home buyer is contact a lender, get pre-qualified. The lender's going to tell you you'll qualify for X amount of a purchase price, and this is what your payment's going to look like. And then usually that lender, if they're tied into the community, if you call like an online lender, mybestrate.com or whatever, not going to probably be able to do this for you. But like if you're working with a local lender, they're going to be able to refer you to a good agent, right? Which if you don't already have an agent in mind, I highly recommend you lean on your local lender again for guidance on who to work with, because that lender is going to know most of the agents in the local territory. They're going to know what agent's going to be a good fit for you based on your personality or your goals, or are you trying to buy an investment property, a primary home, is it a manufactured home? Like they're going to know what agents work that type of deal. So I would rely on them. But most of the time, yes, people find an agent first because everybody wants to talk to an agent because you guys have the good job. You're out showing the houses and, you know, doing the things that everybody that wants to buy a house wants to do. They want to go out, they want to window shop, they want to see houses,
Yes.
they want to get to know the area. They don't want to talk to a lender because we're going to ask them hard questions. We're going to ask them, you know, about their work history, their debts, their assets. And it sometimes can be uncomfortable for people. But what I want everybody that's listening to realize is like, yes, you want to talk to a lender, figure out what you're pre-qualified for. And when you talk to an agent, they're going to send you out. They're going to say, hey, go get pre-qualified, because I don't want to show you houses unless I know you're qualified to buy them, right? Because, you know, your time is worth something. You don't want to go drive around and show 10 houses in a day, and then now they go to get pre-qualified and it comes to find out that they have a bankruptcy that needs to be, you know, remedied, or, you know, their credit needs to be improved, or they need to save more money, or their income isn't high enough, or they need a cosigner. Like all these things that us as a lender can help them work through first to get them ready to go out and start shopping for a home. Don't be scared to talk to us, right? Most of us, I guess I can only talk for myself, right? But, you know, we want to help you. Okay. And we're going to give you as much guidance as we possibly can, right? To make you feel comfortable. And here's another deal. A lot of people don't want to talk to a lender because they don't want their credit to be pulled, right? Most of us these days can do a soft pull. All right. So first things first, if you call me and you want to get pre-qualified, we're going to do a soft pull for you. There's no impact to your credit whatsoever. It doesn't ding your score. It doesn't even show up as an inquiry on your report. Okay. So we're going to do a soft pull for you, figure out where your baseline's at, make sure all the numbers and everything look good. Now, once I say, hey, everything looks great, you're qualified for X amount of money, you guys can go out and start shopping, we're going to have to actually pull a tri-merged credit report, right? Which 9 times out of 10 is going to match the soft pull. It just depends on what lender you're working with. Not all of them pull a tri-merge soft pull. Some of them only pull 1 credit bureau or 2 credit bureaus, and there's 3. And it's important to note too, is like if you're out looking at your credit score, let's say you're using Credit Karma, right? You go on Credit Karma. Credit Karma says your score is a 780. Awesome. Really good reference point, okay, for where your credit's at. And it's a really good tool to use to track your credit, because if you see your credit dip on Credit Karma, then you know something's going on. Maybe you have a late payment. Maybe you're overutilizing your credit, so on and so forth. Maybe you pulled out, you know, opened a new line of credit, had too many inquiries, whatever. But you can kind of dig into that, right? Make sure there's nothing fraudulent going on your credit report, which you can go to myannualcreditreport.com and get your free annual credit report too. I highly suggest people do that to kind of monitor their credit, see where it's at. Because I can't tell you, Ashley, how many times I've pulled somebody's credit and I have to talk to them about a collection account that they had no idea they even had. Okay. And, you know, big culprits are like DirecTV, Verizon, T-Mobile, AT&T, because you'll cancel your phone subscription or you'll switch providers. Well, there was still a $20 outstanding bill for some reason, and you never got notified. They never called you, and it just went to collections. And then the collection company is going to your spam or whatever, and nobody ever contacts you. You have no idea, right? So it's important to monitor your credit on a personal level, because sometimes things like that just happen and you are none the wiser because you never check your score, right? So it's important to kind of monitor that.
That's true. My credit score is pretty decent, you know, but I'm always looking for ways to kind of boost it up. So what if someone has a pretty decent credit score, you know, mid 700s or something? Is there anything that they can do generally? Obviously, it's different for each person, but like kind of generally, what can they do to kind of max that out to be like the highest that they would like it to be?
Well, if you're trying to boost your credit because you want to buy a house, call your lender.
Okay.
Have your lender
Yep.
look at your credit, and then your lender is going to be able to give you advice. Some lenders may even refer you out to like a credit repair company. I don't do that. I've just, from my experience, it seems like a waste of time. Some of them are a little scammy too. So just be very wary of that. Do your research on a credit repair company before you start giving them any money. But a good lender can look at your credit report and give you some pretty solid advice on how to boost that score. Okay. Number one thing, late payments. Okay. That's going to hurt your credit the most. A 30-day late, 60-day late, 120-day late, going to collections. That stuff really impairs your score, right? So stay up to date on your payments. What I'll tell all my clients is set up automatic payments on your credit cards, right? For the minimum payment. That way, like, you never have to remember to pay your credit card before the statement hits, right? It's automatically going to pay at least the minimum balance, okay? So if you're listening to this call and you don't have that set up, please go out there and set that up now, because I'm really, really good at managing my credit, and I have been for a very long time. But I did have a late payment once, and it was just because it was a credit card that I stopped using. I forgot that I had a subscription on there. I think it was Netflix or something like that. And then I got an alert on a credit monitoring app that I had a 30-day late. And I immediately called that company and said, hey, the credit card company said, hey, I'm so sorry. I forgot that, I had this subscription on there. I just paid the card off. And it was like the 31st day. Please remove that from my credit report. And they did. Now, if you're 60 days out and you call them, they're not going to make that exception for you. They're probably not going to take it off your credit report. So again, it's important to monitor your credit. It's important to set up those auto pays. So after that day, every credit card I have has auto pay set up. Another thing is, I suggest, like, if you're paid bi-weekly or bi-monthly, every time you get paid, pay down your credit cards. If you can, pay them off, right? Ideally, this is a perfect world situation, right? Things happen. Sometimes you need to utilize your credit card because of a medical or a car broke down or something. You just didn't have the money to cover it. But ideally, use your credit cards. Don't be scared to use them, but try to only spend whatever, like, money that you already have, right? Just spend whatever you can pay off at the end of the month. But if you're paid bi-weekly or bi-monthly, I suggest paying your credit card every time you get paid. Okay, at least a little bit, if not all of it. That'll keep your balance low. So when your credit is reported to the bureaus, whatever company it is, whatever creditor it is, it's Capital One or Chase or Wells Fargo or whoever you're using, they're going to report on a different day of the month. They don't all report on the 30th of the month, right? So they're going to report on a different day of the month. Usually it's your statement date, okay? So if your statement comes out, let's say on the 28th of the month, and your credit card payment is due on the 30th of the month, the bureau reports your balance on the 28th. You pay your card off on the 30th. Okay. Depending on whatever that balance was, regardless if you paid it off, that's now been reported to the credit bureau, and that's what's going to reflect on your score. So that's why I always like to say, just pay it off every couple of weeks, because then you never have to really worry about, like, when it's reporting, you're keeping your balance low. And rule of thumb is you want to keep it below 50% of your max, your limit. Okay. So you got a credit card limits $2,000 a month. You want to keep that balance under $1,000. Okay. Even better if you can keep it at 30%. That's really going to help build your score, especially if you're in that 700 range, right? And you're trying to boost it. You want to keep your credit utilization at 30% or less, which, again, paying your card up down every 2 weeks is really going to help keep that balance low. Okay. So those are the biggest things that have the most weight on your credit: on-time payments, credit utilization, right? Focus on those two things. Your credit's going to stay in the good range. All right. To achieve, like, a perfect credit score,
Yes.
It's more complicated than it should be.
Okay.
The algorithm is not the easiest thing to understand. Just understand that things that are heavily weighted are those on-time payments and credit utilization, and focus on those. But there's also, like, how long your credit history is. This is important. So if you're new and you just got a credit card and you've only had it for a few months, like, you're not going to have an 800 score, right? They want to see that you have a long history of utilizing your credit. So actually using your credit cards, your installment loans. They like to see different types of credit, right? So your credit cards are revolving, car loans are installment loans. And then if you have a mortgage, that's a totally different type of credit, right? So, the bureaus like to see that you have all these different types of credit and that you're making payments on time. You've got an installment, you've got a revolving, you got a mortgage, all this stuff really helps with your credit. But you got to have a length of time, right? So if you guys only take away one thing from this podcast, I want you to take this away. If you have a credit card from when you were 18 and you don't use it anymore, don't cancel it. Keep that line of credit open because it stays open as a trade line on your credit report. Now, at some point in time, you're probably going to get a little nasty gram email from whoever your credit card's through and say, hey, we're going to close your account due to inactivity. Go to the gas station, put a tank of gas on it, put it back in your safe or wherever. Use it, put it back. Keep that trade line open. If you're constantly getting new credit cards and closing them, that's not good for your credit score either, right? They want to see that they've been open for a large period of time. So what I'll tell my clients is like, if that credit card doesn't have some kind of crazy annual fee on it, keep it open, right? If they're charging you a couple $100 a year for that card and you're not using it, by all means, like get rid of it. Like don't waste money on something that you're not using, right? But most people, when they open their first credit card, they don't open a card that has some type of an annual fee. So yeah, that's huge too. So keep that open. And then number 2 takeaway for credit. If you have a not so ideal credit score and you're looking to buy a house, the fastest way to boost your credit is to be added as an authorized user on somebody else's card.
Okay.
That's been open for a minimum of 2 years and is in good standings, right? So if you have a mom, dad, aunt, uncle, cousin, best friend, whatever, and they have really good credit and they've had, credit for a long time, get added to one of their cards. Preferably one that they use, has been open for a minimum of 2 years and is in good standings, right? Like no late payments on it. You definitely don't want to be added to somebody's credit or as an authorized user, somebody who's got bad credit and it doesn't pay their bills, right? So it's important that you choose somebody that's got good credit and pays their bills on time. But within 30 days, that'll instantly boost your credit.
Really? Wow, I didn't know that because my husband doesn't have credit. So I was trying to think of ways to kind of boost that for him. So if I just put him on my credit card, which I've been meaning to do anyways, that's going to kind of get him a really good fast track.
Yep. Yeah, absolutely. For sure. He should also go out and pull out his own card too.
Sure.
And again, just like put gas on it, pay it off. And then like, you don't have to go spend thousands and thousands of dollars on a credit card. Just use it. And just stay under that utilization. It's important to know too, like if you've never had credit before and you go apply for a credit card, you might get a low credit limit, which isn't ideal for trying to build your credit, right? Because like, let's say your minimum or your maximum credit limit is $500 on your first credit card. Trying to stay at 30% of that can be difficult, especially this day and age. Everything's a little expensive, right? For your first credit card, make sure you're paying that every 2 weeks, right? Keep that balance as low as possible. And another trick too is like if you have long-standing credit history, you've been paying your bills on time, but your credit utilization is a little high, and that's keeping your score, it's like suppressing your score. Call your credit card company, ask them to increase your limit. If you've been in good standing, this card's been open for a couple of years, you're always making your payment, you use the card, they're going to say yes. Your max is like, let's say 5,000. Say, hey, I want to up my limit. And they say, well, how far do you want us to increase it? Say, well, how far will you increase it for me? And if they say, oh, we'll give you 10 grand, 15 grand, whatever, say, deal, do it, boom. Now that whole credit utilization thing is not really a factor anymore, right? Because are you going to go out and put $15,000 on your credit card in a month?
Right.
So yeah, there's some good tips and tricks for your credit for sure.
Yeah, I like that. I've got another one. So some people, like realtors, And a lot of people in Flagstaff in these days are kind of like gig, or they're working on commissions. Their income is, I don't know, fluctuating, or it's just kind of tricky to calculate. So what would someone do if they are like a gig worker, or they're like a real estate where they get paid on commission? I mean, how can you look at the money that they actually make? Because you know, when I put my taxes in at the end of the year, it looks like I made no money, but I mean I did. I just spent it on my business. So what am I supposed to do? How am I supposed to get a loan?
Yeah. Okay. So for self-employed borrowers, it's important to note that if you're applying for a mortgage, your income is going to be averaged over the last 2 years based on your tax returns. Now, if you've been in business for more than 5 years, we only have to use 1 year tax returns. Okay. So that's an important little hack to know too. Most business owners are going to do whatever they got to do to lower their tax liability as much as they can, right? So they're going to write off everything that they can. They're going to go buy a new vehicle in that year because they've made a bunch of money and want to be able to write something off, right? A lot of times we'll have a self-employed borrower. They come in, they're like, "Hey, I made $300,000 this year. I want to buy this $1 million house." Well, it sounds good, but when we look at it as a lender, we might tell you, "Hey, you only made 50 grand this year because you wrote everything else off on your business." And we go based off of basically your net when it comes to self-employed versus if you're a W-2 employee, it's based off of your gross, right? So if you're a W-2 employee, you're making $100,000 a year, we're looking at $100,000 a year. We don't look at, you paid 20% in taxes, you really only made $80,000. We give you credit for the whole 100. Self-employed is not like that. It's scrutinized a little bit more. So for self-employed borrowers, ask your lender if they have outside the box type programs, right? So like we'll do bank statement loans in-house, and they're amazing for self-employed borrowers. The way that works is we look at your business bank statements, right? Hopefully your business is set up to where you have a business account. If not, we can also look at personal bank statements. It's a little bit different of a calculation. But on a business bank statement loan, we're going to look at the last 12 months. We can do 3 months, 6 months, whatever the program is. But typically, we're going to look at the last 12 months of your bank statements. We're only going to look at what money is being deposited into that account. And then we're not going to look at any of the withdrawals, right? Then we're going to divide that, or we're going to average that over 12 months, okay? And then depending on the expense ratio for the program and type of business, like we might cut that in half, okay? And that's your income. 9 times out of 10, it's going to be significantly higher than the income you're going to get based on your tax returns. Okay. Caveat: most of these programs are going to require a decent down payment. You're not going to be a first-time home buyer putting 3% down. Okay. You're going to have to come in with 15, 20, 10%, depending on the program. But it's an amazing loan product for people that are self-employed. Realtors, 1099 loans. Kind of the same deal. We just base your income off your 1099. If you have 2 years worth of 1099s, great. We look at those. We'll average those. We won't look at all the stuff that you're deducting on your taxes. So yeah, there's definitely these out of box. They're called non-QM loans, non-qualified mortgages. Basically any loan that doesn't fit like the Fannie or Freddie or Govy loans like FHA, VA, or USDA loan guidelines. They're called non-QM loans. And there's a loan out there for just about anyone. There's even no ratio loans out there where you don't have to income qualify at all. It could be a loan that's based off of the investment property you're buying. Those are called DSCR loans, where basically you're buying a property, the mortgage on the property is going to be $3,000 a month. You want, as long as the market rent is $3,000 a month, you qualify. We don't look at any of your personal income at all. All right, just based on whatever that property is going to produce. There are also programs out there that allow you to do it based off of short-term rental income if the property was already used as a short-term rental, which, more often than not, it's going to be more than, your 1 year lease market rent type deal. And then, there's no income loans. Now, mind you, you start getting way out into the weeds, like you're doing a no income loan, where it's not based on the property. It's not based on your personal income at all. It's just based, you're coming in with 20% down. rates are going to be higher on loans like that, right? Because they're riskier loans. I guess that's kind of an important thing to bring up too, is when you're applying for a mortgage, everything is based on risk. So your debt to income ratio, your credit score, maybe the property type, the amount of money you're putting down, all those things can be considered risks, or they can be compensating factors. You have really good credit, that's a compensating factor. You're buying a single family home, it's usually a compensating factor. Putting a lot of money down, it's a compensating factor. These things are just going to help you qualify. You've got reserves in the bank, which is basically after your purchase, you've got 6 months worth of money left over in the bank to cover your mortgage. Those are all considered compensating factors. So if you have those compensating factors, you might qualify for a loan where otherwise you wouldn't. Right. So again, it's very important to just talk to a lender because there's just so many different loans out there. The main ones obviously being your government loans, Fannie, Freddie, FHA, VA, USDA, and then conventional Fannie, Freddie loans. Most common loans out there, period. Right.
I feel like
Yeah.
people listening definitely probably appreciate all of the knowledge, but also are coming out of this thinking, man, I do just need to call a lender because there's all these different ways and we're not expected to know all those different ways. That's why we call you. So,
Yeah, for sure.
yeah,
Yeah.
because there's a lot into it. There's a lot into it. So, but we'll wrap up here just a little bit. I want to know from you, Kyle, if people are listening, how can they get connected with you? How can they find you here in Flagstaff and ask you more questions or get pre-qualified?
Yeah. So the easiest way to find me and the easiest thing to remember is just remember my name, Kyle Kent. Google it. All right. You're going to see my Google profile with all my contact information. If you have a photographic memory, you can reach me at 928-308-0368. Call, text, whatever. I'm happy just to have a conversation with you, whether or not you're dead set on buying a house in the next 30 to 60 days or a year. I don't care. Call me. I want to help you. Home ownership is one of the greatest achievements that you can have in life, in my personal opinion. And I think everybody should own a house. And I just want to make that a reality for people. And don't be afraid. No pressure, right? I don't care if you buy a house in the next 60 days or next 5 years. Just call me. Let's come up with a plan. And my answer is never no. It's, if you're not qualified, the answer is not no. It's just not right now, right? Let's come up with a plan to fix whatever issues we need to fix. Come up with more money, fix your credit, so on and so forth. But when there's a will, there is a way. I can tell you, I've done some crazy loans for people that thought they would never qualify. There's just a lot of cool things that we can do on the lending side, right? And again, if it's not now, maybe a year, 2 years, or however long. But at least come up with a game plan. Right? You don't know what you don't know, and if you don't call a lender, and you're kind of missing out. So,
I agree.
yeah.
A lot of people maybe are afraid or they just think, oh, that's impossible for me, or why would I call them now? I haven't even looked at any houses, or all these different things that people think. But in reality, you just pick up your phone, call a lender, and then see, hey, am I able to buy this year, next year? What does my plan look like? What does my actual plan look like? How much money do I need to make? How much do I need to put down? Things like that. So, and some
Exactly.
people do think it's impossible. And that's what I'm hearing. That's what everyone hears online these days from younger people. Oh, it's impossible. Oh, we'll never own a home. But you have to take these steps and you have to try. And, you have to collaborate with people,
Yeah.
local
Yep.
lenders.
For sure.
So,
Yeah.
right before we wrap up here, let's kind of bring it back to Flagstaff. What's one thing, I know this is kind of different than what we talked about, but what's one thing about Flagstaff right before we leave here that you would like people to know, maybe if they're in a different area or, maybe just don't live here?
Definitely a destination place to live, right? I think the biggest thing for Flagstaff when it comes to the state of Arizona is we have all 3 seasons, right?
All 3 seasons.
Well, yeah, okay. So I'm sorry. We have all the seasons. We have we have summer, winter, spring, fall. Arizona, like it. I don't know. It's funny whenever I talk to anybody that's from out of state, and I say, "Oh man, it's cold today," or "Oh, we just got hit with a bunch of snow." They're like, "Wait, I thought you live in Arizona. Like snows in
Hmm.
Arizona?" Yes, it snows in Arizona in Flagstaff. Like
I know
we,
people don't know we have mountains, but
yeah, I know.
yeah.
Yeah, it's crazy, but I mean, in their defense, if you're looking at some type of advertisement for Arizona, you're going to see desert landscape, saguaro cactuses. Um, but down there, you've got a hot season and you've got a nice season. That's it. It's really hot or it's nice.
Yeah.
Um, Up here in Flagstaff, I don't know. I think that's the big draw for a lot of people is just having all the seasons, having ski mountain. It's a very it's not a small town anymore. I mean, you can't call it a small town, but it still definitely has a small town vibe, which I really like. I like being able to go out to the grocery store and see people that I know. That's not for everybody. Some people really don't like that, but I do. I like running into people that I know, right? Um, so yeah, that's probably my favorite thing about Flagstaff.
I like
Um,
that. I mean, Flagstaff does have that small town vibe, but it's not really a small town. There's traffic and there's, all these new stores coming in and oh
yeah,
my
it's
gosh,
grown a
they're
lot.
building all
Yeah,
across town. So,
it's changing for sure, but still has that small town feeling, no matter
yeah, it
whether or
does.
not we have a in and out now.
Yeah,
or
which adds like twice as much traffic down there.
That's crazy. That place is, and it's like right as you're entering town.
Yeah.
I know that's in and out's like business model, right? They got to be so close to a freeway, but we could talk about that for hours. But
Yeah,
um,
that's a different one.
before we wrap up, there is one more thing that I think is important that we take note of, and that is rates. Everybody wants to talk about rates, right? Now, in the last couple days, so today is January 14th, 2026, depending on when you guys are listening to this, but we have seen some decent improvement in interest rates. If you're watching the news, they're going to blast all that stuff, right? Keep in mind, too, when they talk about the Fed fund rate, that's different than mortgage rates. There is a correlation there, but it's not tit for tat. If they say they're going to cut by 25 basis points, doesn't mean mortgage rates went down 0.25%. Okay, that's another large misconception. But we have seen some improvement over the last couple of days. I don't think it's going to be here to stay for very long. We saw a similar dip back in September of last year, lasted like 3 days and it was gone. Rates went back up. So if you're listening to this within that time frame, you need to refinance. Now is a good time to reach out to your lender and see where rates are and see if it makes sense. Because, like I said, I don't know if it's going to be here for very long. Another very important factor or important note to make is in today's market, and it's not always going to be like this, it's not here to stay. Markets change and shift all the time, but we are still seeing a significant amount of offers being accepted with seller concessions. Now, as a buyer, seller concessions are worth their weight in gold, in my opinion, because you can use that money to cover closing costs and or buy down your interest rate in more ways than one. There's temporary buy downs and there's permanent buy downs. That's a topic for a different day. I just want you to take away that if you're wanting a rate in the 5% range, call and talk to your lender. Say, hey, what do I got to do to get a rate in this range? And more likely than not, they're going to say you're going to need X amount of concessions on this purchase price. We'll buy you down to that rate. This is what your payment's going to be. And then go out there, look for houses, talk to your agent, figure out what homes they think would be willing to negotiate based on how long they've been on the market or seller sentiment. Like, do they have to move out quickly? Are they priced too high as it is anyways? Talk to your agent about concessions and get with your agent on or your lender on how that's going to help you. So if you're working with a lender already, or you start working with a lender and they don't bring that up or at least provide you with a scenario on that, ask them, because it's a game changer for people, especially right now in today's market. Again, markets shift all the time, so 2 weeks from now, you listen to this podcast, maybe it's in a different market. It's now a seller's market, not a buyer's market. You may not have that leverage, but explore it for sure.
Things move fast. Yeah, things
Yeah.
move really fast. So I'll put this little end clip up as a little sneak peek so people can see it. Because yeah, if your lender's not telling you that, then ask them or call Kyle because maybe he'll tell you.
I'll be here for sure. Again, just Google my name. Easiest way to find me.
Well, thank you. This has been really fun. I feel like we could probably keep going for another 6 hours on this stuff. So
Oh, yeah.
let's have you come back. And I think people who are listening need to know this information. And like you said, it's not really common sense to most of us, but it should be. And that's
Yeah.
what we're trying to put out there for people.
Fortunately, they don't teach this stuff in high school. They really
Yeah,
should.
not even at all. Not even anything at all about home loans.
I didn't have one economic class period.
I had one. It was financial advising or something, but you know how
Better
those
than what I
classes go.
got. Just got
Yeah.
zero.
Yeah.
I think most people rely on information from their parents. Um,
Which is
and
tough if their parents have bought one house in their whole life.
well,
You know.
that and not everybody is in the best financial situation anyways, right? I mean, like
Totally.
your parents may be very well versed when it comes to, the financial conversations and what to do with your money and how to save it and how to invest it. Or maybe you came up in a family where like that wasn't even an option. There wasn't enough money to even be invested. And so again, like them not teaching it in schools really, I think handcuffs a lot of people. And heck, yeah, like a lot of this stuff, like the credit stuff, I didn't learn that until I became a lender. I was just lucky with my credit. I just tried to make sure I paid my bills on time, but I had no idea how it worked. Didn't know 30% utilization, didn't know trade line history mattered and tenure of like how long you had your credit cards open and authorized users, all that stuff. Like they don't teach you that stuff in school. And unless you're actively looking to learn that stuff, you're not going to know. So like I said, you don't know what you don't know. Call somebody that can help.
That knows. Call somebody that knows. So, all right. Well, thanks, Kyle. We'll see you next time. I'm going to go ahead
bet.
and wrap this up.
All right. Thanks, Ashley. Thanks for having me.
Thank you.
All right. Bye.